Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's July 11th, 2023. We got a big show coming up. We're going to cover the markets because the markets continue to chug higher and people are wondering why. And then we're going to dive into your questions. For all the support you've given us over the years, we took your questions from social media on individual stocks. We'll give you our views on that coming up right now on Making Money. Over 1 million people around the world follow Wall Street veteran Mark Chaikin for his shockingly accurate stock market predictions. He just gave them a dire warning. Mark says, we're about to witness an historic stock market shakeup that can soon create devastating losses for investors who don't know what's coming. And as a result, you only have 90 days to move your money. You see, Mark spent 50 years on Wall Street at some of the most prestigious hedge funds in history. And he's been on Fox Business and CNBC countless times. But this is a financial story no one else is telling. And if you let this take you by surprise, you could be in for a world of pain. He explains everything in a brand new free report available at rollingcrash2023.com. He includes a name and ticker of a popular stock that could be directly impacted by what's happening as well. Mark warned of the beloved pet brand Chewy before it fell 45%. Tech company C Limited before it fell 66%. Furniture company Wayfair before it fell 76%. Social media favorite Snap before it fell 36%. And food delivery company DoorDash before it fell 65%. Mark even called the Amazon crash before the FANG stock fell 35%. So you'll want to avoid the stock in this new report immediately. Again, simply go to rollingcrash2023.com for your free copy of this new report. Again, this is Matt McCall. Thanks for joining us. It is a Tuesday, and as you can tell by the amazing painting behind me, we are still in Nicaragua for a couple more weeks down here with a little remote office. July 11th, when I said it, it kind of rang a bell for me. I have to write down a reminder, which I did right now, my phone below here. That is my mother's birthday. So if she's watching, happy birthday, Mom. I will give you a call here later today. Busy morning. But as I mentioned, we're going to take your questions here today. So I posed this even just this morning. I posed a question on Twitter about individual stocks you'd like me to give my analysis on. Just a heads up before we get into that, obviously nothing here is ever a buy or sell recommendation. It's pure educational. And of course, we're going to have fun and hopefully make some money along the way. But we're just giving you my view. And my view is not always correct. Keep in mind, there's two sides to the market. On every time there's a trade, there's a buyer and there's a seller. So somebody thinks it's going up and somebody thinks it's going down. So you may not always be on the right side of that trade. But we will give you our analysis. And I have a bunch of stocks here I've already written down that people have talked about and asked about. And there's some really good looking companies in here. Some really ugly looking ones too. I didn't pick just the good ones. We picked, randomly some good and some bad. Before we get into that, let's take a look at the S&P 500. Here's the SPYs, the SPY, the ETF that tracks the S&P 500. And this is still very early. We're about an hour into trading here on Tuesday morning. We're up about 0.13% or so. But as you can see on the right-hand side of the chart, we're not far from a yearly high. And we had a little bit of a pullback late last week, Wednesday, Thursday, Friday. And then we had a nice day yesterday, a little bit of a follow-through today. But that little blip off that yearly high doesn't look like much. It feels like a lot when it's taking place last week. And of course, individual stocks move a little bit more, but overall, folks, I got to tell you, this looks pretty damn good. It's tough to argue with the chart that we're looking at right here. I also want to take a look at the QQQs, which is the NASDAQ 100. And that is the 100 largest stocks in the NASDAQ, X financials, no financials included. Very similar chart. We came up close to a one-year high last week before a bit of a pullback. We're down about 0.15% today, so tech stocks are down a little bit. But really, such little movement early in the morning on both sides, on both the S&P and the NASDAQ. All that being said, folks, we're holding up really well. And you can see on this right-hand side of this chart that for the last month or so, we've been consolidating really at a one-year high. And all things considered, we have the Fed coming out basically saying we're going to raise interest rates again at the July 25th, 26th meeting. That's coming up in 2 weeks, as you can do the math. We also have earnings season kicking off this week, and the consensus estimate is for earnings to be down year over year about 7%. If it is negative, there'll be a third consecutive quarter of negative earnings growth. If it comes in at that -7, it'd be the worst year over year earnings decline in 3 years since the second quarter of 2020, which of course we know was in the government-induced shutdown from COVID. So obviously there's no economy moving at that point, or very small economy moving at that point. We also have the expectation of revenues year over year to be down 0.4%. This would be the first decline in revenues going back to that same quarter 3 years ago. So, we have all this negative kind of expectations already baked in, and the market continues to hold up. I view the earnings situation right now is, almost always earnings tend to come in better than expected, unless there's some type of event out there that's taking place, whether it be through COVID or something else, or the Fed being more aggressive than we thought. But again, the Fed's already kind of written out their roadmap. We know they're going to raise interest rates unless something dramatically changes. We've seen inflation numbers continue to come down. That being said, we have the CPI this week, so that could throw a little bit of monkey wrench in, but I don't see that being a big deal either, because the trend is that it's moving lower, as we've been talking about for many, many months now. So at the end of the day, folks, we've priced in the fact that inflation is still higher than we want it. The Fed is still going to be aggressive and probably make mistakes. We kind of have that in there. And earnings are going to fall, yet the market stays up. So that kind of tells you the resiliency that we have right now in the market. Let's jump into some of these Twitter questions here. And again, these are random. I went for kind of first come, first serve. Then I picked a couple others because I didn't want to have two small companies, but some good, some bad. The first one is Zillow. And we all probably know Zillow as the online real estate company. Symbol is Z. It has a secondary shares that trade as ZG, but we're going to talk about Z here. About $11 billion company. And this company is truly based off of the real estate market, the housing market. And real quick, before we get into Zillow, we've talked about this in the past, but take a look here at the Home Builders ETF, which is symbol ITB. And you see here on the chart of ITB, this is one hell of a chart. Last June, this was trading in $48 a share. Now it's at 84. Look at this. And there's this dichotomy because people say, the housing market stinks right now. It's not good. Prices are going to crash. They're going to come down. And prices have come down. Not that much, all things considered, considering where interest rates and mortgage rates have gone up. It really hasn't come down that much. And you can see here the home construction index here, the ITB, has held up very well just off a high. So Zillow, let's take a look at Zillow's chart and kind of match this up with ITB. And as you can see here in Zillow's chart, it's pretty similar. This happened at bottom in October, around $26 a share. Now it's at $52.71. Simple math tells me the stock's up 100% from the low in October. That's a big move. Happens to be up 10% today, and I'll tell you why in a second. But as I mentioned, $11 billion company, a real estate kind of tech firm, if you want to call it that. And if we take a look at just the broader housing market and how it kind of tracks it, it looks as if right now a lot of it has to do with inventory. The inventory right now, half as many homes available than there were in 2019. I'll talk about that in a second. May existing home sales were down 20%. May new home sales up 20%. Even with the 30-year right now mortgage rate being around 6.8, 6.9%. The thing is, there's new homes that usually make about 10 to 15% of home sales. Now it's about 31%. And the reason is because rates have spiked so quickly over the last 18 months, so many people are locked in at 30-year mortgages, high twos, low threes. So if they were to sell their home and make money, a lot of them have been up in 18 months, they have to go buy a home that's also inflated, especially if it's in the same geographic region, and then locking in at a higher interest rate, potentially double the interest rate, increasing your monthly payment dramatically. So why would you sell? So everybody's sitting on their homes, which means inventory is lower, which I think is keeping the housing prices up because it's supply demand. The supply is not there and the demand is still there, not as much, but the demand still is there. And that's what we're seeing. That's why we're kind of seeing kind of a very odd housing market right now. What I love about Zillow, though, it's like it's an addiction for let's say middle-aged people. You know, the young kids are on TikTok and Instagram and whatever the hell else they use. Then there's the people a little bit older like me. I don't anymore because I have no desire to own a home in the United States at this point, but people do. And when I was looking for homes, which was pretty much nonstop for the last few years, constantly in Zillow. Every morning I call up and see if anything new houses came on. You talk to people now, there's just not a lot of new homes coming on because I mentioned inventory is low. But that will pick up at some point, especially as new homes come on, and you will see Zillow really take over. And it's really it's a trend that's not ending. We call it the tech real estate marketplace, not just your traditional realtor. That is not changing anytime soon. They're saying, according to a study by an analyst here, that Q1 was the strongest year-over-year share gain for what we call tech real estate versus traditional real estate since 2018. That trend's not going to end anytime soon. And I've been saying this for years, and I always get flack from it because I have family who's in real estate. I think realtors are dinosaurs. I think they're a thing of the past. And I talked about this about a month ago on the show. The number of realtors is starting to drop off dramatically. Number one, because we're not seeing as many homes for sale, so there's not the need for it. Two, they're getting eaten up by Zillow, Redfin, and these other online companies, which you don't need realtors anymore. They really don't. It's just a middleman that we'll get rid of. And again, no offense to anybody who's a realtor. That doesn't mean all of them go away, but majority will go away. So anyway, Zillow, not a bad looking company, I'll tell you, but it's going to be all based on the housing market, which I think will be resilient as well. The next one's a bit smaller of a company. MAXN is a symbol, and this is a play on solar. It's a company I don't know that much about, honestly, but obviously I know quite a bit about solar. And Maxeon Solar Technologies, if you take a look at a chart here, I'm pulling up here in a second. Not a bad looking chart. The year ago was down around $11. Now it's at 25, so it's more than doubled. But it was up at 38, and we've pulled back since then. I actually like the pullback that we've seen. You don't see a lot of big volume coming down and pullback, and we had some decent volume on the upswing. $1.3 billion company. This company was spun off from SunPower, which you probably heard a little bit bigger name in 2020, third quarter of 2020. And this was the portion of SunPower's business that was the upstream manufacturing operations. That included manufacturing facilities that are located Southeast Asia, over in Malaysia, Philippines, also one in France, and also one in Mexico. They also own a 20% stake of a manufacturing operation in China as well. And they operate solar cell and panel manufacturing facilities. So they actually manufacture the solar panels. Really nice top line growth. They have a price of sales of less than 1.0. Not profitable yet, but if all goes well, this will be the first annual profitable year here in 2023. And the demand for solar continues to increase. And it could get to a point where these solar panels come in more like commodities. But at this point, I think that the company looks pretty darn good. It's a smaller company. It's obviously a micro cap at 1.3%. It's obviously volatile from 11.38 to 25, all in about 13 months. So you're going to see a big movement on this. But you look at what's going on in the world right now. Who knows where they get these numbers from? Who knows how accurate they are? But they're basically saying 4 of the last 7 days or something are 4 of the hottest days in the world, based off global temperatures and ocean temperatures and everything. I don't know if I believe it or if it's true. It's just what I'm reading. So don't get mad at me. I'm just a delivery boy here. But we do know that there's a increased demand in areas around the world. Texas being a specific region, you're seeing huge demand for electricity because the heat has been so high, obviously, for air conditioning. So you've seen a huge pickup in solar energy, solar electricity versus traditional oil and gas supplying electricity. I don't know off the top of my head. I read it this morning, but I will admit that I lost it. It was in the Barron's article over the weekend talking about the heat in Texas, and the percentage of electricity being generated by solar has increased dramatically going back to the last heat wave that we've had in Texas. So obviously you need more solar panels for that to happen. So I think Maxeon's in a really, really good spot. Expect huge volatility with this company, but not bad looking. If it does turn profit this year, that's a good sign. You want to always have a company that's either about to turn profitable or has that path to profitability. So this company here I'm about to talk to you here is OPRA, OPRA. This is a company that one of my analysts has pitched to me a few times, and going back, I think it may started pitching in April or May. I wish I would have listened to him because it'd be up over 100% right now. I mean, look at the chart on this. This is OPRA, OPRA, up again another 6% today to $26 a share. Going back to October, it was below $4. So you can do the math, how much it's up since then. It's a $2.2 billion company. And they basically a browser company, browser technology, but they're real well known for the privacy and security of their browser. A lot of people use it for gaming as well. But the big thing that we've seen with OPRA as of late is their integration of AI, artificial intelligence, into their browser. They did announce a collaboration with OpenAI, the company behind ChatGPT, and one of the executives came out and basically said, Opera became among the first browsers to have support for popular services such as ChatGPT directly in our browser sidebar, as well as innovative AI prompts. So, you can use ChatGPT in your phone or your browsers, but they're integrating it right into the browser. So they're a step ahead there. And, this browser is not as well known as Internet Explorer or Chrome or any other ones out there. But try it. I mean, I tried it because obviously, I always try anything that I potentially am going to recommend a stock. And I'll tell you what, I liked it. I really did. It's a debt-free company. Its margins are increasing. It's been one of the biggest winners over the last year. My concern always is, okay, it's gone from less than $4 to 26. So it's a little over 6x in 12 months, less than 12 months. How much higher can it go? It's only still a $2.2 billion company. Again, I wouldn't buy it here on a pullback. Maybe it's just run so much. I feel like I've missed it, but heck, this could be a $10 billion company for all I know in a few years, and say I missed it again. But this is a great company. If whoever asked this question owns it, congratulations. And, this uptrend's doesn't look like it wants to slow down. I mean, it will at some point, but man, oh man, you ride that trend as long as you can. Next company somebody asked about, we're getting a little bit smaller here. And this is a company that is EV/battery company. Name of the company is Canoo. The symbol is GOEV, GOEV, about a $250 million company. Stock has gotten crushed, to say the least. If you take a look here at a long-term chart, it trades around 50 cents right now, 52 cents to be exact. This stock was above $24. It was a SPAC back in 2019, took off in 2020 and ended 2020, early 2021. Above $24 a share, down, as I mentioned, down to 52 cents right now, only worth $250 million at this point. They had an announcement yesterday, which is interesting. Stock was up double digits, up 10% or so at one point, ended up down 10%. And they announced that they have a follow-on contract to an original February 1st contract to supply battery modules to the DoD, U.S. Department of Defense. And but the thing is, they announced that the contract's been expanded. However, they did not put a number on that. So it's tough to really, as an analyst or investor, say, okay, we got this big contract. Well, how much money? What's big to you may not be big to me. So the stock got hit on that. They really have no revenue as of yet. They lost about $450 million in the last 12 months. At the end of the last quarter, at the end of March, they only had $6.7 million in cash on hand. So that's a huge concern. I mean, that's not a kind of company I want to put money into. All that being said, and again, these are pure expectations. But when I look at the analyst expectations for Canoo, they're quite crazy. Last year, I guess they had a little bit of revenue. Sorry, $2 million in revenue. The expectations for a $250 million company, mind you, is for revenue of $104 million this year. That's a hell of a gain. I like that. But you still have to make money. The estimate for revenue next year, $935 million. Year to that, $1.93 billion. If that were to happen, I would change my mind. But I got to tell you, if the contracts were that big that you're getting from the DoD or anybody else, you'd be bragging about that, putting out headlines. So there's a concern. If there is a path to that, maybe the company makes it, but it's going to have to raise quite a bit of money along the way, diluting current shareholders. So again, a company to me way too risky at this point, and his reasons fallen from $24.50 at this point right now, and announcing what appeared to be a pretty bullish announcement yesterday through a government contract and falling again tells me something. One other EV stock I want to mention that's been on fire because a lot of people asking about this. I believe there was a question on Twitter about this as well. Is Rivian, RIVN. And of course, we all know Tesla, the big name, and the legacy automakers that are getting into it. Everything from Ford, GM to overseas to Hyundai to Volkswagen, you name it. But Rivian, US based, you can see here in the chart, it was at below $12 in April. Now it's at $25.34. Huge money coming into it, and it's because they reaffirmed their annual delivery guidance for this year, 50,000 units. And I read an article, or I read this somewhere. I didn't come up with this, but somebody talked about recently, is this Rivian's Tesla moment? And I think what they were trying to say is it took many years for anybody to believe Tesla could go after, at that point, the big three in the United States, or even then go internationally and become such a powerhouse in the EV industry. And obviously it's done that and more. At one point, it's $1 trillion company. Rivian, still much smaller, but you can see here how much it's moved as of late. And I got to tell you, maybe it is their moment. I mean, Rivian's still only a $23.7 billion company, so still minuscule compared to Tesla and some of the bigger names. All that being said, the deliveries, if they continue to increase like this, obviously increase your top line, bottom line. Last year did 1.65 billion in sales. This year looking for 4.1. Next year 7.7. Next year 11.5. So you are seeing potential revenue increasing. The one asterisk I'll put next to it is Tesla and Eli's legacies are profitable. Rivian has no path to profitability in the near future. Not saying they won't, but nothing in the near future. So be careful of that, because obviously at some point you can't keep raising money. You got to make some darn money. But it is one you want to put on your watch list. Switch gears a little bit here. We got 3 more stocks left for you. BKR, which is Baker Hughes, which is a oil field equipment company. You can see here in a chart, boy, Baker Hughes has actually done pretty well as of late and just broke to a 1-year high this week at the best levels since June of last year. I like that because you've been consolidating quite a bit. We've had some good volume on the upside. And all this in the face of oil and gas still kind of consolidating around the $70, $80 level. So it really hasn't broken out from there. I wrote about oil recently, I believe on Monday's daily insights that we put out, which goes out every day that the market is open. And that's free. Just give us your email and get free email every day the market's open with some headlines and my view of them. And one was talking about oil prices. And, at this point, oil prices are going to go one direction or the other. They're either going to break out massively, run back to 100, or break down to a new level, probably get back down to the 60s. I don't know which way it's going to go yet. It's based on a lot of outside factors. If China's economy continues to pick up, the heat continues around the world, we have the U.S. avoid any recession, probably moves higher because demand's going to increase. We also can look at the fact that the U.S. Potentially could be producing more oil this year than any year on record. That helps supply. And if China doesn't boost its economy, that hurts demand. We could see prices go down. So one way or the other, but oil prices, I think, are set to make a pretty big move here in the near future. So Baker Hughes is about a $33.5 billion company. As I mentioned, oil field services and equipment. You saw their sales bottom in 2021, obviously COVID. And then we had a lack of demand for oil. So we didn't have, and oil prices, remember, went to zero essentially before bouncing back up. So we didn't have a lot of money going into oil field services and equipment. But it looks like the next few years we have some really nice runway going forward, both the top line and bottom line. Trades at a PE ratio around 16, price to sales 1.2, has a 2.3% dividend. So all really nice numbers for a larger company. But again, this all goes back to oil prices, which way it's going to move. So if you think it breaks out, this breakout for Baker Hughes probably continues, and it could be a nice move for you. The next one, again, logo a little bit smaller here. A company I honestly don't know much about. I like the sector though. LFMD, which is LifeMD, is the name of the company, and it's a telehealth company. And as you can see here in the chart, in the last few months, it's gone from about $1 in March up to 5.25 today. It's at 5.06, down a little today. Huge volume coming into the company. But if I kind of look at a longer term chart here for you to give you an idea where it's come from, you can see here this was a stock that went public back in 2010. Was always single digits and exploded in 2020 up to $32 a share before coming down. And a lot of that had to do with because it's a telehealth company with COVID. Everybody sitting at home and they can't go to the doctor, and telehealth took off, obviously. Now the company's worth about $170 million. It's had really big top line growth, but it's still losing money. And the other thing that concerns me, we talk about cash. Its latest cash numbers is saying about 11.5 million in cash. That being said, the telehealth market is still expected to grow. And there's some telehealth companies out there that I'm starting to put my eyes on because I don't think it's going away. I'd recommended Teladoc to my past subscribers way before COVID happened. And that ended up being a huge winner for us. Even prior to COVID, it was a big winner. And then obviously a huge winner after that. And Teladoc is basically the big guy in the room. But 35% compound annual growth rate is what is expected from now until 2032, so the next 9 years. That will take this telehealth market up to about $402 billion market. If that's the case, there's going to be a lot of big winners in telehealth. The one bit of news I found about LFMD when I was going through the notes this morning was they formally launched a weight management program after their successful pilot earlier this year for GLP-1. And to put that simply, that's the diabetes, obesity drugs that I've done a couple shows on. So they're doing a weight management program with that where you do telehealth with a doctor and they prescribe that. So that could be a huge boost to this company because a lot of people don't want to go in and talk about that. Really easy to do it with telehealth. That could be a big boost. So it's a company to keep an eye on. It's moving a lot. It's small, it's volatile, very, very risky. The last one to take a look at is SoFi, SOFI, company I'm pretty familiar with. And this has had a big move. And I've talked about this, I think, in the past, where it's moving on is basically the non-forgiveness of student loans. Thank the Lord. And the stock's gone from 4 and change over 10. We're about $9.12 today, having a nice day. It's here in chart, a little choppy, but $8.5 billion company. And student loan reversal was really, that was a big thing, saying that really not going to be able to get this through any time to forgive student loans. Solid growth, both top and bottom line, but likely won't be profitable for another 2 years. And that's a bit of a concern. They have 3 divisions that they run. Everybody thinks about the lending, and that's the student loan side of it. They have a technology side, and they also have a financial services side. Financial services is where they're trying to be, like a traditional bank, checking, savings, credit cards, all that type of stuff. And their vision is to really bring this all together and be this kind of conglomerate for the new wave of the financial services industry, which includes lending, which includes traditional banking, which has technology into it as well. They bought a company called Galileo, which is a platform, technology platform for the financial industry. But what I like about it is at the end of the first quarter, they had 5.7 million members. That was an increase of 46% year over year. That's really, really great numbers. What also I like is that on average, every SoFi member is using at least on average 1.5 of this product. So they're cross-selling really nicely. And that's a huge part of a successful business, especially when you're offering all types of different services, everything from home loans to personal loans to student loans to banking to credit cards, etc. So I still love this company long term. I think it's a very risky play. Because they obviously have the big guys, the big banks can come in and crush them at any point. It's only an $8.5 billion company, but I think it's very well positioned. It's had its run up because of the student loan situation. May consolidate somewhere around 7 to 9 in there. I think it's probably a nice long-term flyer, honestly. Again, a very aggressive company, even though it's worth $8.5 billion. All right, folks. Again, thank you so much for submitting questions. I know there's a lot more. I can't get to all of them all the time. And it's usually last minute when I do this. So you may have submitted after I taped the show. But we're going to start doing some other things. I think we're going to try Twitter Spaces here coming up, which will be a live show. We can take your questions, which I think will be great. We're going to get some good guests on. I'm going to be a guest on a Twitter Spaces coming up in a couple of weeks. I forget the date, but with somebody else, I'm going to be doing it. So we're going to give it a shot and see if we like it. But more interaction with you. Without your support, we wouldn't be here. So again, thank you so much for the support. Thank you for listening, watching, yelling at me when I say something you don't like. That's okay. I yell at the TV all the time when it comes to sports. So it's all right. I get it. If on this end, I deserve to get yelled at sometimes. But again, don't forget to comment, like, subscribe, and share with your friends and family. So I hope you have a great rest of your day. We're back Thursday with one of my favorite guests of all time, one of my favorite people of all time, Stansberry favorite, back with Doc Eifrig on Thursday. So thank you so much for watching. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.